Hello everyone, welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. So today we will be learning about financial modeling, but before going forward with our new topics which this webinar is arranged for, we are not here to talk about complex financial theories or big corporate jargons. We are here to talk about your business, your money, and your future. If you understand how much you are earning, how much you are spending, and how much you need to save or invest, you already understand the basics. So this webinar is all about making finance simple, useful, and practical. Whether you run a shop, provide a service, manage a household budget, or plan to start something of your own, we will take you through easy concepts like how to know if your business is growing, how to understand returns and profits in simple terms, and how to use financial modeling as a tool, just like a calculator, to make better decisions. So sit back, relax, and enjoy the journey where we will be connecting finance to your daily life with real examples, stories, and a lot of clarity. So let's begin this session of turning numbers into powerful business decisions. So in our previous sessions we have learned about common size statement, and it is of two types. Like first is our income statement and balance sheet, which we have already prepared in our previous session. So if you are new to this channel, so please start with the basics first and then come to this webinar so that you will get a clarity of what we are doing in our session, right? So in our previous session we have learned about our common size statement, where we have prepared multiple statements like income statement and balance sheet. So now we will be doing our intrinsic growth rate calculation in that particular sheet only. So let's move on to that particular. Right, so we have understood our common size statement which we have prepared yesterday. So how to do that and why companies made that, we have cleared all our doubts regarding it. So I will not take much time in this common size statement as we have completed in our previous session and it was crystal clear to you all. So let's move on to our intrinsic growth rate. But before making intrinsic growth rate, what we will be doing, we will be making our raw financial statements. Raw financial statement in the sense we have made in our previous sessions that historical financial statements we have already made, then ratio analysis we have already done, forecasting is done. Now when we want our intrinsic growth rate calculation, what we will be doing, we will be making our raw financial statements. So what to do in that particular thing, we will be going again in our screener.in. I have taken company Eicher Motors and I will be sticking in that particular company only, and in my Eicher Motors I will be taking my balance sheet and I will be uncollapsing these all the heads, and I will be doing one thing. I will be starting with my December 13 and moving down, right, and Control plus C to copy, and then I will be pasting it over here. So like this you will get, if you don't click Control Alt and V, this is the format it will get copied from. So we don't want it, so we will do one thing, we will delete it and write, then Control Alt and V. If we want to paste, then we will have to convert it in text. Now it will look like this, right? So what to do next, we just have to do some formatting over here. So I have done formatting over here. Now I have to put my data over there. So what to do in that case, so I will be taking this data, not copy pasting, I will not copy paste it. First I will be removing these borders so that I get my work done easily, right? So my December 13th equity capital, how to link it, what we will be doing, we will be linking it like this, So our 27 is there and done. Then borrowings, it is asking us, so before moving to borrowings we will be copy pasting the same thing, but as we are doing financial modeling we will be linking our every single task which we will be doing in our statements making, right? So this is how our equity, capital and reserves are done. Now borrowings, so in our borrowings it is mentioned 5823, and before that we don't want March 25 because many data is missing, so we will be taking till March 24, and then we will be linking our long-term borrowings with our balance sheet. So it will be nil because there is no transactions in December 13. Equals to short-term borrowings, again control plus C and drag it till the end, right? Then lease liability equals to this one, control plus C and paste it, right? Then other liabilities it is asking us, so other liabilities we just have to calculate if it is giving us the same number till this. It is giving 3829, yes, so we don't want this. So what we will be doing, we will be keeping it like this only, and equals to non-controlling interest, this control plus C and March 24, drag it till the March 24, right? Then trade payables equals to, again going down this one, control plus C and drag it till March 24. Again the same thing, advance customers March 13, control plus C and drag it till the end. Now other liability terms, other liabilities item, we have to find it, right here it is, control plus C and drag it till the March 24. Right now it is time to calculate our total liabilities. So what I will be doing, I will be making top border and also I will be making outside borders to bottom border also, right? So what will I do, alt and equals to, it will be taking all the data. So first we have to check is it taking this data or not, and same work will be doing for this. Now fixed assets, so we will be taking fixed assets, land, again going down it is like this, control plus C, and so we have taken our one data and then copy paste it till the other fixed assets. So for checking it we will compare it by 1177 and 117, yeah we are correct. Then gross block, it is asking us, so equals to moving down and done, control plus C and drag it till the end. Now it is asking us accumulated depreciation, so for the same thing what we will be doing, so it is asking us accumulated depreciation, so we will be making it as equals to minus this, control plus C and drag it till the end. Or we can do one thing also, as we have to calculate in our intrinsic growth also, we just do one thing, we will link it like this. Why I am linking it? Because I have done the formatting over here. Otherwise, if you guys want, I will do one thing also over here. I will take this whole data from here and will paste it over here, right? So we will get confused regarding this. So we will do one thing, we will take small portion of data and copy paste it over here, right? Now long-term borrowings, if we delete this particular thing, then it will show us error because we are linking it, right? So we will do over here, right? Again, non-controlling this, and now alt and equals to, it will be taking whole data, control plus C and drag it till the end, right? Our data will be the same, our calculation will be the same. We will just do one formatting over here like this. Okay, so this is now formatted, right? Now what we will be doing, again I am deleting this borders from here so that I get my work done easily without any problem. So okay, right, now land and so we will be taking this data till accumulated depreciation as it is having already, right? Now I will be calculating my net block, so alt equals to, the same thing will be done over here also, right? Bold it out. Then it is asking a CWIP, so it is this and investments, so we will be right, sorry, we have done, okay, so this is done. Then inventories, we will take it as it is because it is our company's data itself, and what we want, control plus 1, I don't want 0 to be seen, so what I will be doing, I will be taking this data and copying it, providing semicolon, same thing will be pasted over here with brackets and semicolon and dash. So now my formatting is looking good as per our works. Okay, so just a second, what I will be doing, I will be doing format painter over here also, so that I don't have to go again and again for the same thing. Right, so this is done. Then this place is also done, control plus C and drag it till the end. Now what I will be doing, I will be taking this as format painter and dragging it here also, and I will be doing this formatting also so that I don't forget these things. And this is done, and now we can do one thing, we just bold it out and delete this table, right? Because we have to enter more data over here. So this raw financial statements is already made. Now what we will be doing for our work easy, what we will be doing, we will be going to our cash flows on the same site and will be copy pasting the same cash flow statements which we have done earlier also, and control alt plus V, then text, and then OK. So this is what our cash flow statements will look like, and we will be removing March 25 as we haven't taken it in above scenarios, so we will not be taking this also. Just a second, there was a issue, so just a second. Again we will do a copy pasting. Again what I have done, text thing, working capital changes, what it is showing in working capital changes. So it is showing direct taxes, control alt and V, and text. Why it is taking again and again date, working capital changes, if we write control alt plus V, and then we will do it, we paste it over here, right? We haven't taken 25, so we will not take it. So what is the meaning to do this work is to work out a little bit. So March 25 is not required, so we can just delete it out, and 211 is, while preparing any statement you have to be very attentive so that you don't do any mistake. So it was 25's data, and we will take it little bit like this. Again the same thing we have to do, we have to expand it again. Here it is bolded out, this is different, and this is different. Whatever we have done in our preparation, we will be doing it over here also. We don't want this dates, and is it giving us from December 13? Again we will do one thing, control alt and V, and text to be copied, right? Now we don't want March 25's data to be given to us. We will delete this particular sheet, so our data is over here, right? It is in numbers, so we will be doing short date, and control plus 1, we want only MMYY, so right, or this one, right, correct. So it hasn't taken this data which is of 24, short date, this one, and this formatting is required in every stage, right? So this is deleted and this is bolded. Then okay, so what is the problem over here? We are getting, again, just remove it. What happens over here? It is not opened, right? So again, what we will be doing, Control Alt and V, then text and OK. So now our data is given to us in a right format. These are all changed to our date, which should be in smaller version like this, right? This is deleted. This is also deleted because it is the total only, and also this is also removed. This is our net cash flow, so we will bold it out. So this is what our cash flow statements will look like, and we will bold it out, right? This is also should be bolded. It should be in this place also, and on this place, right? So that it should stand out from the other data, right? So what I will be doing, I will do one formatting again, Control+1, number, custom, this, not this one, this we have taken, and we will just copy this type and done. This is how we want our data to be look as good. Now what we will be doing, as we have made our raw financial statements, we will be moving forward to our intrinsic growth rate. So here I will be taking 5 years data only. So for current assets, what I will be doing, I will be going to my raw FS, and it is asking us about our inventories. So I am taking from March 20. It is over here, right? Control+C and drag it till March 24. Same thing will be applied till the end, right? Total assets should be all equals to done, Control+C and dragged it till the end, right? Now it should be bolded. Current liabilities, so here also what we will be taking equals to trade payables. It is asking us raw FS, above it was, right, not this one, this one, because we are taking 5 years data. This one is done, right? Now we will bold it out like this, and some formatting to be done over here. It is required to be like this. What we will be taking this color, and we will be doing our formatting like this. We don't want this to be right. Now it is asking us net working capital. So what we will be doing, we will be clicking equals to, then we will be subtracting our total current assets minus our liabilities, Control plus C and drag it till the end, right? Or we can do one thing also, equals to this minus this, Control plus C, it will be the same only. Now moving forward to our non-current assets, which are land. So we will be taking it from our raw FS from March 20, this, Control plus C, and other fixed assets till this. What we will be doing, again the formatting, we will be taking it on next level so that we get our data more sophisticatedly. So number, custom, and this data I don't want decimal, semicolon and bracket, and this particular range to be selected over here, and semicolon and dash, right? So it is looking more professional now. Now gross block, which is already with us in raw FS, it is for March 20, right? Control plus C and drag it till the March 24, right? Now accumulated depreciation, what I will be taking, so that I will be taking in minus, so that I will be getting the data exact, right? So from March 20 it is asking, right? Control plus C and drag it till the end. Now net non-current assets, so we will be taking sum of our gross block and what we will be doing, alt and equals to, okay, so we don't have to do this, alt and equals to, right? This is done. Now moving forward, invested capital, it is asking us, so what we will be doing, we will be adding our non-current assets plus our net working capital, which is this, Control plus C and drag it till the end, right? Then EBT it is asking us, so we will be moving to our historical FS, which we have already made, where we will be taking EBT, which is this, and adding the interest for the same year, Control plus C and drag it till the end. Now we have to calculate our ROIC, which is EBIT divided by our invested capital, which is this, Control plus C and drag it till the end. So this is what our return on invested capital we have gained, right? Now we have to do one small formatting over here, Control plus 1, number, this one, custom, and I want this, or yeah, I want this one, copy pasted it, semicolon, bracket, pasted it, semicolon and dash. Now it is looking more good. So for this, Control plus 1, it can be 0, okay. So for this, what we will be doing, deleting, okay, so right till this area we have to do formatting, otherwise we get again that particular problem only. Copy this, semicolon, bracket, semicolon and dash, right? This is looking good. Now we have to calculate our net capex, which is net capital expenditure incurred. So what to do in that, we have to go to our raw FS and find out our fixed assets purchased and sold. So for this moment we have taken our cash flow statement with us. So for that, what we will be doing, again going to our intrinsic growth rate equals to sum of raw FS, this two, and close it down, control plus C and drag it till the end, right? Then change in working capital. So it is asking us change in working capital. So for that, we will not take it for here, right? Equals to working capital for 21 divide minus this one. So complete, yeah. Copy this and control alt and V. We want only format to be copied, right? Like that. EBIT, we will be linking it with our EBIT which we have already calculated, control plus C and drag it till the end. Then marginal tax rate we will be taking as 25%, as it is hard coded. And what I told you all before also, that why we are taking this, because it is a long-term opportunity. So we will be taking this as italic, and for EBIT we will be doing 1 minus tax rate. So 1 minus tax rate is 25, and control plus C and drag it till the end. Now what I will be doing, I will be copying, or I will be doing a small formatting, as it is hard coded. So for calculating our reinvestment, what we will be doing, we will be taking our net capex, which is this, plus change in working capital, which is not available over here. So we will be taking it for this, or we will remove it and we will take it for here. So it is giving us some error, so just ignore the error. Same goes with these part also, right? So now we have to calculate our reinvestment rate. So for that, what we'll be doing, we will be taking our reinvestment divided by our EBIT, which is 1 minus T, and control plus C and drag. It is not required over here. Now investment rate it is asking us, so equals to reinvestment divided by our EBIT, which is this, control plus C and drag it till the end. So this is how we make our intrinsic growth rate. Okay, now moving forward with our session today, we will be discussing about relative valuation, price to earning ratio, enterprise value to EBITDA, price to book ratio, EV upon sales, dividend yield, buyback yield, total shareholders return, beta, and regression approach to beta, and bottom up beta. So starting with our what is relative valuation. Relative valuation means finding a company's value by comparing it to other similar businesses. Just like people check the price of similar houses before selling their house, businesses use valuation multiples to estimate their worth. This method does not depend on internal forecasts like cash flows, but rather on market driven ratios such as PE, PB, or EV upon EBITDA, right? So for example, if we are running a restaurant by making 10 lakh rupees profit yearly, nearby restaurants with similar profits are selling their particular restaurant for 1.2 crores. That means they are valuing their earnings at 12x earnings, right? They have valued their earnings by 12x. And also, if we calculate our company's worth, so it will be around 1.2 crores only, where we have multiplied our 10 lakh with our 12, which is 12x. So I will be getting 12 crore, 1.2 crores, right? So for instance, Infosys and TCS are often compared using PE ratios. If Infosys has a PE of 20 and TCS has PE of 25, it shows TCS is priced higher for each rupee of profit. So if Infosys is growing faster but has a lower PE, investors might see it as undervalued, a common use case of relative valuation in stock markets. So relative valuation helps investors, analysts, and business owners quickly gauge value by what others are worth, right? Then comes our price to earning ratio. So here PE tells us how much investors are willing to pay for 1 rupees of a company's profit. It's one of the most common and popular valuation tools in investing, right? So the formula is PE ratio is equals to market price per share upon earnings per share, right? So if a company shares, so for an example, if a company's share is 200 rupees and its earning per ratio is 20 rupees, then PE ratio will be 10. That means investors are ready to pay 10 for every 1 rupees profit, right? So for an example, Hindustan Unilever often trades at a high PE ratio, which is sometimes over 50, because investors expect consistent growth, strong brand power, and steady profits. ITC has had a much lower PE, making it attractive to investors looking for undervalued opportunities. PE is also useful when comparing companies in the same sector, and low PE could mean a company is undervalued or it may be in trouble. High PE can mean overvaluation or strong future potential. So, if my friend is earning 1 lakh rupees per month and is priced his particular shop at 12 lakh rupees, which is PE of 12, so and my shop earns rupees 2 lakh per month, so might be my shop's worth will be 24 lakh by same logic, right? Then comes our why we prepare it. So it helps us how much comparison you are spending or earning relative to total sales or assets, even if the actual numbers are small or large. This is very useful to compare our business with other businesses, no matter their size. Then comes our enterprise value to EBITDA, which is EV upon EBITDA, is used to value a business by comparing its total worth, enterprise value, to its earnings before tax, interest, tax, depreciation, and amortization, which is EBITDA. It's better than PE for companies with debt, since it considers both debt and equity. So why it matters? So for the same thing, we will be taking EV upon EBITDA. So for that, say an example, enterprise value, which is 100 crores, EBITDA is 10 crores. So we will have to calculate our EV upon EBITDA, which is 10x, which is the 10x of enterprise value and EBITDA. So this means the business is valued at 10 times its annual operating profit. For example, Zomato doesn't show regular profits, so PE is not useful for that. EV upon EBITDA gives insight into its core operating performance. EV upon EBITDA to compare Zomato with global food delivery platforms like DoorDash or Swiggy. So for an example, we have taken our EV upon EBITDA. Now coming to our next topic, which is our price to book ratio, where the PB ratio compares a company's market price with its book value, for example, net assets or shareholders' equity. It shows how much investors are paying for every 1 rupees of net asset. So for that same market price per share upon book value per share is there. So for example, our stock is 100 rupees and book value per share is 50 rupees. So our PB is 2 rupees. For example, banking and insurance companies like SBI or LIC are often valued using PB ratio. SBI trades at a PB of 1.2 while HDFC Bank trades at 3.5 times. It means the market expects HDFC Bank to be more efficient with its assets, right? Then comes our next topic, which is EV upon sales. So this ratio is used to value companies with low or no profit, especially in early stages. It compares enterprise value to total revenue sales. So for that particular calculation, we have to divide enterprise value by revenue. So for an example, our EV is 100 crore and our sales is 25 crore. So our EV upon sales will be 4. So startups like Paytm, Nykaa and Policy Bazaar often have low profit or losses. In such cases, PE can be used. So analysts apply EV upon sales to compare them with similar global companies like Amazon or Shopify, right? Then coming to our next topic, which is dividend yield, dividend yield shows how much a company returns to shareholders as dividends relative to its share price. So for an example, for formula is dividend yield is equals to annual dividend divided by market price. So for that particular calculation, our dividend is 5 rupees per share and our share price is 100 rupees. So dividend yield is 5%. So it means ITC is known for its high dividend yield, sometimes above 4 to 5%, making it attractive for investors seeking regular income. So in contrast, companies like Infosys and Reliance reinvest most of their earnings and give lower dividends. So that particular topic is dividend yield. It is already clear. Then come buyback yield. Buyback yield is the percentage of the company's market cap that is repurchased in a year. It is another way of returning value to shareholders apart from dividends. So for that calculation, buyback amount upon market cap is there. So for an example, if a company buybacks 1,000 crores worth of shares and has a market cap of 50,000 crore, so buyback yield will be 2%, right? So for an example, TCS and Infosys regularly do share buybacks. So this increases share value by reducing the total number of shares, improving per share earnings. Investors see this as a sign of confidence, right? So think of it a little group business with 10 partners, and in that particular business 2 partners leave, so their shares are bought back. The remaining partners shareholdings increases at that time, right? So it's just like that, buybacks boost shareholder value, right? Then comes our total shareholders return, which is TSR, is the total return an investor earns including capital gains plus dividends plus buybacks. So it gives a complete picture of what investors earn. So the formula for TSR is ending price minus beginning price plus dividends plus buybacks upon beginning price. Then comes our beta. So for our TSR, over 10 years, Asian Paints has consistently provided high TSR due to price appreciation and dividends. Similarly, Infosys has delivered solid TSR due to both capital growth and share buybacks. So TSR is the best indicator of real return to shareholders, not just stock price growth, right? Then comes our beta. Beta measures how much a stock moves in relation to the overall market. If beta is equals to 1, stock moves same as market. If beta is less than 1, stock is more volatile, and is more than 1 is more stable, right? Then comes the example for the same. Tata Motors may have a high beta because auto stocks are sensitive to market and economic changes. HUL, a consumer staples company, usually has a beta more stable, right? Then comes our regression approach to beta. To calculate beta, analysts use regression analysis, plotting a stock's return versus market returns and finding the slope of the line. This slope is equals to beta, which we have discussed in our previous session with the image also. So it shows how much the stock tends to move when the market moves. So for example, analysts calculate beta of Infosys by regressing its weekly returns against Nifty 50. So this helps portfolio managers decide how much risk they are adding to their portfolio. Then comes our bottom-up beta, where it is used when a company is private or not yet listed. We take betas of similar public companies, unlever them, which is removing debt impact, and then adjust it for the company's capital structure. So for that particular formula and example is valuing a startup bakery, you can take beta of listed food companies like Jubilant Foodworks, unlever them, and adjust for our bakery's debt to get an approximate beta, right? So it is like guessing your shop's performance based on how nearby shops perform after adjusting for how much loan we have taken, right? So as we come to the end of the today's webinar, I want to thank all of you being such a engaged and curious audience. We are explore some of the most important tools in the world of financial valuation, from understanding basic ratios like PE and PB to diving deep into concepts like EV upon EBITDA, beta, and total shareholders return, with their examples also that how they mean in real life scenarios. And what we have learned today is not just theory. These concepts are being used every single day by investors, analysts, and business owners across the world to make informed financial decisions. And more importantly, these tools help us bring clarity and structure to something we all care about. Yes, which is understanding value, whether it is a business, an investment, or a personal project. Remember, even if you don't come from a finance background, with a little practice and the right mindset, financial modeling can become a powerful decision making tool in your hands. So keep learning, keep questioning, and most importantly, keep applying these financial modeling tips and tricks and shortcuts. Thank you once again for joining this session. Wishing you great success on your financial journey. See you in the next session.